All right, go for it.
Good afternoon, everyone. Today is Wednesday, March 26th. Thursday, March 26th, 2020. We tend to lose days in the quarantine. And this is Ken Schortgen of the Gadfly and ShotgunEconomics.com, here to bring you a market wrap-up on all things going on in the financial realm and the general economy. Well, we got to see in the markets today where bad news is great news. We had over 3 million Americans apply for unemployment insurance, but that led the Dow to get 1,300 points, the S&P 500 154, and the NASDAQ about 400. And it's going to be interesting to see because as you can take a look at the last 10 minutes of the trading day, the spike up there, we're going to take a look at what the S&P 500 did. The desperation for speculation, say that three times fast, is leading everybody to think that this is the time to get back and buy the dip. But we have yet to see, since the coronavirus really is still in its building stage, we haven't reached a peak. So anybody who's buying into the markets are doing so purely out of speculation, and that the Fed is going to be pumping in money for the next 100 years, aka America is now Japan. Meanwhile, this is what the S&P 500 did in the last 10 minutes. 40 points, the biggest 10-minute move in the history of the indice.
Wow. Wonder who that is.
Well, it had to do with a $7 billion market imbalance at the close, which meant that there was $7 billion worth of buys, and it took something, and we're not quite sure since the markets were closed about an hour ago, where they actually got the equities to buy. So that's still in limbo, but needless to say, there is so much liquidity going around trying to find a home because the Fed is primarily buying bonds, but it's got to do something to pump up the stock market, and that's where the investment banks and the hedge funds are trying to sell to the public. It now is time to get into stocks. Ironically, the two stocks that were the biggest movers today are ones that have some of the worst fundamentals on the planet. And we're talking Boeing, which needs a bailout or it's going to be insolvent and bankrupt, and Chevron, where oil prices are at six-year lows. Go figure. Meanwhile, the bond market was just sort of scrambling along. We still have the 3-month in negative. We have the 2-year that is getting close to negative when you add in all the variables. And the 30-year had a huge auction today, which drove the yield down until late in the day when it did finally eke out a gain. Meanwhile, the big loser of the day was the U.S. dollar, down $1.64 in the index. To not only lose the 101 handle, it lost the dollar handle. Now, there's a question of what is really going on with the dollar, because if it gets stronger, that means that there's less dollars in use, both domestically and internationally. But every single central bank is increasing debt to the moon. So what is the problem here? Well, Jim Rickards had a pretty good article on this today, and we're going to take a look here. Second quarter U.S. GDP may drop as much as 30%, which is a staggering figure. Many economists predict a third quarter recovery, but there's too many unknowns to actually say what's going to happen. And it's still too soon when America will reopen for business. You can't just flip a switch and return things to normal. That's not how economics works. Many industries may never recover. Millions may be out of work for an extended period of time. At the very least, we're heading for a severe recession. We could well be heading for a full-scale depression. That's not being alarmist, but here's where the crisis is. We talked about, Jim Willie has talked about this before. The dot-com bubble was a collapse of the equity markets. The 2008 financial crisis was a collapse of the banks, and this one is going to be a collapse of the central banks. And with the fall of the central banks, it's also going to be a collapse of the singular global reserve currency. The dollar represents about 60% of all global reserve assets, 80% of global payments, and almost 100% of global oil sales. About 40% of the world's debt is issued in dollars. Now, here's where the problem is. The reason the dollar is the world's leading reserve currency is because there's a very liquid dollar-denominated bond market. Investors can go buy 30-day, 10-year, 30-year treasury notes. The point being that it's deep, liquid dollar-denominated bond market where a lot of money goes in, especially when transactions are done. You're not going to send over pallet loads of dollars to China with our $650 billion trade deficit. We're going to send over treasuries. But with that being said, here's the problem. Most observers are surprised to hear about a dollar shortage. After all, didn't the Fed just print almost $4 trillion bail out the system in 2008 and $4 trillion over probably the past 7 days? That's the huge, where is it? Yes, but while the Fed is printing that money, the world is creating 25 times that amount of dollars in new debt. The huge debt pyramid was fine as long as the global growth was solid and dollars were flowing out of the U.S. into emerging markets, but that's no longer the case. That's an understatement. Global growth was anemic before the crisis hit, and now it's contracting rapidly. The point being, out of all this, is that while they're using the coronavirus as a scapegoat to why we're suddenly having this global collapse, the fact of the matter is that the entire system was on the edge of collapse with the warning signs of 2018 when they had to raise it or lower interest rates, in 2019 in September when they had to open the repo markets for liquidity reasons. The entire thing was just on a string, on a razor's edge. And the coronavirus, by shutting down countries and borders, shutting down supply chains, is the catalyst that took everything, the black swan, if you want to call it, that took everything and just broke it wide open. Now, the question, as Jim Rickards asked, come the third quarter, are we going to be able to restore it? The answer most likely is no, because each country is in a different state of decline. So you're not going to be able to just say, okay, let's turn the switch and everything's back to the way it was. No, there are going to be many countries that are already insolvent. The amount of debt that's going to be created just to sustain until supply chains and trade can get back on track is going to be massive. You think $100 trillion now is, we are probably going to be near that point where I said the world is going to learn and understand a new word by the end of 2020, and that word is quadrillion. And this is the whole purpose behind it is once the central banks got into printing mode, they will never stop printing infinity until it completely collapses. And the collapse will evolve around the dollar, the reserve currency, and the global currency reset. Moving over to gold, well, as you can see, the last 1, 2, 3, 3.5 days, we've been trading sideways with a low of about 1588 and a high of about 16. What are we going to say? 1645. So it's trading sideways, which is surprising because we have a nice little story. We have finally hit the mainstream. Now, we talked about this over the last couple of days, both I and London Paul and others in the alternative media, but now the mainstream has finally gotten on board. There is no gold. That's right. Bullion dealers are selling out in panic buying. If you think the gold, U.S. gold has jumped about 10% in a couple of days to 1638, the official price quoted by Wall Street, think again, the real price, nearer to $1,800 if you can get it. There is no gold, according to Josh Strauss, partner at money manager Pekin Hardy Strauss in Chicago. There is no gold. There's roughly a 10% premium to purchase physical gold for delivery when it's usually like 2%. I can buy a 1 ounce American Eagle for $1,800. $1,800. Major gold dealers have sold out of coins, gold bars, amid panic buying in the U.S. economy plunges, and the government agreed to a record $2 trillion emergency lifeline but that's more like the lines of about $2 trillion every 2 or 3 days. Fact of the matter is, the LBMA or the COMEX is asking, the CME through the COMEX is asking the LBMA for actual physical gold to cover the contracts. But the CME runs on a 100-ounce bar and the LBMA runs on a 400-ounce bar. So there's a disagreement right now of whether the CME is going to accept and start selling 400-ounce bars, or if the LBMA is going to have to cut their bars into quarters so that they fit the 100-ounce requirements. Either way, the amount of gold that is being panic bought across the world, central banks, billionaires, millionaires, and just about anybody who has finally caught on to the fact that the fiat currencies are crap, are finding that not only are they unable to pay a spot, anything near spot price for gold, but finding it even at your local dealers is becoming near impossible. Meanwhile, Bitcoin, well, out of all the asset classes that really hasn't done jack squat over the past few days, it is Bitcoin. As you can see, it's also trading sideways over the last 3 days with a high of about 68.28 and a low about 65.85. $300 trend is not really that much for Bitcoin, which has a tendency sometimes to trade $1,000 or $2,000 in a single day. As you can see, the volume is right just below average being normally $500 million of Bitcoin traded per day, and the market cap for cryptocurrency as a whole has only gone up $1 billion in the last 2 days. Meanwhile, oil. Hopefully everybody who has gone out of their house, at least for a little bit, to either the grocery store or the gas station, has seen that gas prices have begun to fall en masse. Matter of fact, my local one, it's dropped about 30 cents in the last 2 days, from $2.96 down to $2.67, and it's only going to go even further. West Texas Intermediate crude was down $1.31 today to close out at $23.18. At earlier parts of the day, it was in the 22 handle, and Brent crude is down 79 cents to 29.20, and it was down below or into the 28s a little bit earlier. So there's been some buying, especially in the last, as I said, 10 minutes of the trading day. Now, one of the more interesting things to see why there's no expectation that the oil industry, or oil prices are going to get any higher soon is what came out from the Dallas Fed on their oil data models today. This is the business indicator for the first quarter of the oil industry. And take a look. Level of business activity, minus 50.9. Capital expenditures, minus 49.4. Employment, minus 24. So the layoffs are they're cutting employee hours by 32.1%. Wages and benefits are being cut. And look at the outlook, negative 75. So
wow.
When it comes to what oil is going to do, the expectation is that as the coronavirus continues on, probably through April and into May, maybe by the beginning of June, we shall start to see summer beat down the virus. We could very easily see the oil price below $20. And if that happens, forget the shale industry will have to be continuously bailed out by the banks, by the Fed, or by taxpayer bailout for the next decade or more, because they will be completely, absolutely insolvent. Meanwhile, guess what we had today? Unemployment shatters record, 3 million claims. Now, take this with a grain of salt, okay? Because this was expected, and actually there were some who were thinking this number was going to be 7 million. But with the Labor Department reporting today a record number of jobless claims surging to 3.28 million, the number shatters the Great Recession peak of just 665,000 in March of 2009 and the all-time record of 695,000 in October of 1982. Since everybody was forced either by the federal government or the state to quarantine in place and not go into work, it should be no surprise at all that people are rushing to get the unemployment insurance even before Congress can finally get this bloody coronavirus bill out of the House and into the hands of President Trump to sign. Meanwhile, the last thing I want to talk about is the question, did Wall Street insiders know that the system was going to collapse even before the coronavirus epidemic came to be? Well, here's some new data out. Amazon's Jeff Bezos and other corporate execs sold billions in stock before COVID-19 even rocked the market. Bezos and other corporate execs cross-country sold approximately 9.2 billion in shares of their own companies between early February and the end of last week, salvaging potential losses of up to 1.9 billion, according to analysts looking at more than 4,000 regulatory filings by the Wall Street Journal. The largest seller, of course, was Bezos, who sold 3.4 billion of his Amazon shares back in the first week of February, right before the market peaked, which avoided paper losses of about 317 million. Now, this is just insider selling just before the epidemic, but we've talked about this before. We're going to take a look at it again. Why did hundreds of CEOs resign just before everything started going crazy? CEOs were leaving in record numbers this year, with more than 1,332 stepping aside in the period from January through the end of October. That was last year. According to new data released on Wednesday, last month alone, which was February, 172 chief executive officers left their jobs, according to the placement firm of Challenger Gregg and Christmas. What a name. The highest monthly number on record. And the year-to-date total output outpaces even the wave of executive exits during the financial crisis. By the end of last year, the all-time record high, 1,480 CEOs left their posts. But to most people, it seemed like the good times were still rolling at the end of 2019, with corporate profits rising, the stock market setting record new highs. This tells you something of why the old adage is, if you want to be rich, you do what the rich do. And if the rich are selling, that doesn't mean it's a good time for you to buy. Sorry, cough button there. But this is the world we're living in, and it's one of the reasons why here at the Gadfly we've been talking about preparing for this day, going back the 2 years we've been at the Gadfly, or the year and a half, and 10 years for London Paul, CJ, myself, and Dr. Jim Willey, speaking about how the scenario was going to come about when we saw the consequences of the 2008 financial crisis, the bailouts, and the ever-moving QE that was going to lead central banks to be the primary ones who will be the failed entities, thus leaving nations to have to come together to decide what is going to be the new system, the new currency, and the new way that economies are run. Anyway, I want to just thank everybody, as always, for stopping by on this Thursday to get your market wrap-up for March 26, 2020. I want to thank CJ for running the helm today at the steam yard. I like to call it the barnyard. And just everyone look forward to more information as it comes out. We will either have morning shows, afternoon shows, or roundtables all throughout the time that we're dealing with this epidemic and the collapse that is occurring before our eyes. So until the next time we get together, everybody have a great Thursday.